Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, March 17th, 2026. It's 11:18 a.m. Eastern Time, so we're about 2 hours into the trading day. I'm just going to give you an eclectic mix again of which I like to do, some of the things I'm watching, and I wanted to reiterate, as I mentioned yesterday, I don't know if any of you caught it. I'm now able to run through. I tried to do this a few months back, and it wasn't working on because the videos I post, they're almost all non-public videos, and Gemini wasn't parsing those videos, and now it's doing that. So what I did yesterday, here, let me show you real quick. So now I do have to wait till the video has been uploaded, processed on their servers. I guess I got to kind of get all those little bits and bytes into everything. And so I'm going to follow up with these when time permits. Any of you are welcome to do it. I don't know. I have a Gemini Pro subscription. You might need that. The the idea mentioned by, again, forgive me if I mispronounce the name, Extalion. He is using what do you call it? YouTube Premium to summarize the videos, or at least to search for coverage of a particular security. But here's what I'll do going forward. So again, if you want a quick summary of the video, it's what I did yesterday. Shortly after the video, I ran it through Gemini. Remember, Gemini is owned by Alphabet, Google's parent company, also owns YouTube. So I imagine you're not going to have an AI machine that's going to be a little any more effective. With that being said, I've noticed some slight hallucinations. So I recommend when you have the time to watch the videos, especially if you're interested in any topic. But what's really cool is you can see here, I just had to cut and paste. I had to do it in two parts because of the limitations on text. I have it set. These comment sections can't be too long. And so I did it in two parts here. But really good job. It started out covering the broad markets, and you can see anything with the little dots below, or if you hover and your cursor turns in. I'm saying this maybe for the older generation. Most of you young bucks know that. Those are hyperlinks, and if you click that, it's going to open the video to that point. Again, so you can see what's being covered, a little bit about it. Again, I've noticed it's not perfect. It can and often will hallucinate a little bit. So you want to maybe, if you're interested in something, don't take any of this AI summary as gospel. All right, that's enough said on that. So there it is. So what's covered at what point in the video, and then here's it also gives you the video sections and timestamps in just quick glance right here. So. Again, we had a while back, for a little while, I guess he got tired. He got tired of doing it. A subscriber was doing this for us, kind of posting at which point I covered different securities. And you guys know me. Again, I do my best to try to keep these videos fluid, but my brain, the way it's wired, it's very tangential. A lot of these things are absolutely connected. I cannot impress the importance enough about the credit markets, which I've been doing. It was back, I checked last night, I think it was August, where I picked up and started first warning about business development companies. And the only thing about it now is every Tom, Dick, and Harry, every article I'm reading, YouTubers are all picking it up. And to check things like that, if you want to go back in time, you just click on the symbol link below a post. So there's BIZD, and then you can go down here. Here's all covered. So if I go to and I didn't pick up on them until here in the beginning of August. And if you watch that video, you can again summarize it with AI. That's towards the tail end of the video. I talked exactly what's going on today, how that not just are they in trouble if they broke that support level, which they did. And even in that target on August 7th, in that video, I said if they did break that support where they were testing, where they would go, and then we made it official, meaning an official trade idea. Let me move this up, just move it down a bit, go to daily chart, and that was August 7th right here. You can use Google and find out if anybody was talking about or warning about business development companies and private credit, and that was the magic number. And in that video, I give you one sole target. I said if they break that, they're probably coming down to here. Then I went on to give you specific intermediate targets, and we hit that to the penny. So again, a prediction made back in August before anybody was talking about private credit. There was the sell signal. If you missed it, you had a back test. And again, you can see how many times I covered it since. And when we got there, where I predicted we'd drop if we broke this level, biggest drop in the swiftest over such a short time period, other than this right here, that's when the regional banks were crashing. And remember, the Fed had to come in and backstop them. In that video back then, I also talked about how the relationship that it's not just, even though this is only a $1.5–2 trillion sector, that they have a tremendous amount of loans out to these private credit companies from regional and big banks. And so then I predicted you would see spillover into the regionals, and all that's come to fruition. And so again, you can check that out. We gamed it then, covered that short, went long, sold the close along there, and then recycled back in there. And here's where we are today. So look, I guess where I'm going with this is, I tend to be, and that's one reason I call the site right side of the chart, with the little, and because anything to the left is history. And at times I can be, well, we were certainly not too far in front of it now. The Johnny-come-latelys that are talking about private credit imploding now are talking about it here. They started talking about it here, and now more and more, again, every headline and all over the internet, they're talking about that. There's a downtrend line that was broken, but we're back at resistance. And I'm going to just tell you that I still think there's a decent chance of a credit risk in the market. Now, credit risk can come from anywhere. It can come from this. We've already had, as you know, a lot of these companies basically imploding if you look at their stock price, shutting down redemptions. Some, I've heard some of the smaller ones, at least one went bust. And it was a very small one. But these guys are leveraged. Again, I don't want to spend too much more time on it because I've covered it ad nauseum. And the only thing giving me a little pause right now is the fact that everybody and their brother's talking about it. And now this is the next shoe to drop. So I think it could come from somewhere else. I do think this was the start of what has a domino effect. Again, talked about in that August video. It would spill over. If they had problems here, it would spill into the regionals. And then, of course, that's happened. It took a while, but once it became very blatant to the masses there was a problem with private credit, then the regionals finally broke down. And, that was our sell signal right here, KRE, the regional banking ETF. And they're currently testing the 200. So where I'm going to just kind of wrap this up is, this all goes, if you want to really know how, if you're new to the site, or I do these super long videos and extensive coverage all the time, a video, sometimes 2-3 a day for, day in and day out for years. The biggest overriding factor that just most people don't get and don't talk about, and I've been talking about it forever, is this. It's interest rates. And again, it is not mere coincidence that private credit is starting to blow up. And again, the banks are still relatively doing very well. They're not too far off of the regionals, obviously coming down lately. And XLF, the regional, the main ETF for the financial sector. We've had shorts on Visa that we've been in for a long time, very profitable. We already hit 5 out of 6 targets, calling things like that down. But guys, this is where my background in, as a business major, former stockbroker, this is just economics 101. And they're really going to have to rewrite all the textbooks if this doesn't play out. And my point was, and again, I just don't hear it talked about enough because it's such a big macro picture. And number one, most don't see it. Maybe I'm wrong. Maybe they see things different from me. And those that do believe that, okay, this is just, a quick lift in rates and we're going to go back down. The Fed's just going to, every time the market sneezes, catches a cold or even hiccups, they're going to come in and blast it with quantitative easing and helicopter money and all that stuff. That's been the belief. But as I've covered many times, this was a secular, this downtrend line defined it. I have 2 downtrend lines. the primary in this price channel, secular bear market in rates. You can't see the left because this chart, the 30-year bond doesn't populate beyond previous to 1977. But that's when we had runaway inflation, systemic bear markets. It went from the 60s into the late 60s into the mid 70s. The stock market did nothing. It had a series of was just dead money for years with corrections, bear markets, and that was due to the rising interest rates. And so, guys, again, if you, I'm not here to sell anyone on my mindset. I'm here to share my analysis, share both long term. I talk macro sometimes, and that I know confuses people because I'll talk about being bullish on gold and then turn around and shorting gold or the miners for a swing trade, for a pullback trade. I'm looking for 15% correction. And same thing with the stock market. There are times I tell you I'm long this, that, or the other, and including the indexes. But so don't ever confuse a longer term outlook with swing and active trading. Two different things, right? All right. So, but this is it. And again, I don't think it's talked about enough, and that also hinges on me being right, my analysis. But by every single metric in technical analysis, everything that I've ever used and learned, including just a simple definition of a trend, which is a series of higher highs and higher lows, boom, 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 and also taking out of a primary very super well. Guys, this isn't like 6 months, 6 years. Stock markets have been in a trading range right now for 6 months, 6.5 months. And it's one of the bigger, tighter sideways trading ranges. I talk about that daily. But this was a multi-decade trend line that started right around the beginning of the 80s there. And it was very well defined. And the channel had just a few quirks. And these quirks were the rounds. This is where the Fed started to get really come in and realize how powerful a weapon money printing, quantitative easing was. And that was a financial crisis. That's why you see that spike down in treasuries there. And then we had additional bouts, again, every time the stock market hiccup. And then, as I've said often, they hit the all-out nuclear button and panicked to an extent not seen in the history of the world. Both, not just the Fed, not just the ECB, every central bank around the world with both. That's monetary stimulus, and then we had fiscal stimulus throughout all the big governments, printing checks, giving everybody money, backstopping businesses, rent forbearances, you name it. And so that gave this super duper explosion off those in yields and bonds. But again, it shows you that this, again, you can take it glass half full, glass half empty. I'm not here to sell you on which way you need to think. If you want to be the glass half full kind of gal or gal, I'm talking about the stock market, you say, okay, well, that's fine. These were just super duper low rates, abnormally low. But Randy, rates are back to where they were right here right around before the financial crisis started. And so, but the problem that I have, again, I'm talking longer term fundamentally, is that the economy, the world economy, the global economy, became absolutely addicted. And not, it's similar to a heroin addict. The longer you use it, maybe you shoot up heroin once, you're fine, you have a good high and say, okay, that was on my bucket list, I'm good, but I know not to do that again or I'm going to become addicted. That felt too damn good, right? But you keep doing it, you're going to become addicted. So the global economy became addicted to ultra low interest rates, and it created all kinds of excesses. And more importantly, it's simple math, guys. Businesses, corporations, small caps tend to run around the 4 to 5 year range, I believe I've heard, and large caps about 7-8 years as far as their average debt issuance. So meaning, to finance their operations, selling bonds, borrowing money, loans that are due around that time. And so, just about everybody and their brother refinanced back then. We know that that's the problem with the housing markets. Everybody like me, I nailed the lows, and I had just bought a house right when COVID hit. I had a 3.5% mortgage. I thought, how in the hell can you beat a 3.5% mortgage? And then about a year or two later, I refinanced at 2.49 with points back. So that effectively lowers the rate under 2.5%. That's And that's free money. That's tax deductible too. Take the tax deduction out of that mortgage interest. And so that's what. Now, guess what? I locked in for 30 years. But again, my point is businesses don't lock. They do, some issue 30-year bonds. Don't get me wrong. I'm talking average, and I'm talking small caps. So you take this point where a lot of debt has come due, and I'm not the only one that's been talking about this. There's there's going to be a lot of refinancing. Now we're from the COVID lows. Again, a lot weren't doing much then because they thought the world was coming to an end. So most of the refinance occurred here and here and here. But you can say down there too, in that range. Anyways, so from COVID, I just want to point out, from these extreme lows, we're now, you can see the pop-up box on the left and the bottom. We're 6 years into that mark. So this, guys, is what's going on. And how many times have you heard the media tell you that Fed was going to cut rates, and they did, and that interest rates would go down and it would help mortgages, and then, as you know, it didn't. Right? Again, I've spoken this ad nauseum as well, repeatedly. Let me get back to it's on my daily chart. This is where it became very apparent to me the Fed lost control of the bond market. They cut rates with a whopping 50 basis points, typically a cut only reserved in times of emergencies and financial crises in the past. They usually start and move in quarter point increments. And as again, I've covered quite a bit, long-term rates went the exact opposite way. That was a WTF moment for the Fed. Now, we predicted it. You can go back and look what we were doing on bonds. We traded bonds like one of the best trades percentage-wise that we've had for the last couple of years. If you look at the success rate on trading treasuries, and again, it's all been priced into the charts. They cut again. Rates went up at first, came down a little, but then boom, back up. And then they made a third cut and rates just continued to climb. This is the 30-year bond. And at that point, they backed off. They said, ruh-roh, something's wrong. We keep cutting rates, but the bond vigilantes are showing up because they think it might be inflationary. And sure enough, they sat up, waited a year, did again 1, 2, 3 back-to-back rate cuts, and look where we are. We're above where we started. This is September 17th right there. Is where we cut started cutting rates, and rates continue to move up. So this is, again, long-term 401k, not what's going to happen today, tomorrow in the stock market. But I can say with the highest degree of confidence because, again, guys, this is economics 101. Any of you that have a business degree or even any college degree where you took economics courses, macroeconomics, you know that rising interest rates stifle economic growth. Falling and low rates are a stimulative for economic growth. If I have to explain that, then grab a handbook and you'll know why. And the other thing is, besides economics, is a stock market, and I've said this many times in the past, we've had former Fed chair men and women, Yellen, I believe, said it. I know Bernanke said it. They've acknowledged outright, and we know it to be true, they've at times will come in, and they did it in the financial crisis and other points, they cut rates to push money into stocks, to boost the stock market from a not so much a psychological impact, but simply an alternative. Because when they bring rates down, and they were able to do it very successfully since the financial crisis until they lost control after COVID. And what that does, and believe you me, I know this as a 15-year career stockbroker, former to becoming a professional stock trader, that when interest rates are high, if Granny can get 8, 9, 10%, even 6% on her CD, FDIC insured at the bank, or a Treasury bond, and more so institutional investors. Think insurance companies, pension plans. Historically, that's where they had a lot of their assets, especially in the higher rate environments. And the Fed has forced them and everybody, even old grandma who shouldn't be taking any risk, but when she was going into her bank a couple of years ago and they were telling her 7% CD would now come and do it, we're going to pay you, 0.75 or 1%. And again, take that into, don't black and white this. It's not just grandma, but it's all investors. You give me right now 15% on T-bills, I'm going to, When that reaches that point that day that I don't feel like sitting in front of this computer every day, I'll just shift a lot of my money out of the stock market and do that. And I know a lot of people will. So, guys, it's an incremental, gradual thing. Don't underestimate the power of that. In other words, the alternative. So, when rates start going up, yes, even the 10, and look at the midpoint of the yield curve, 5, 10 year bonds and the long bonds, you will see it siphons money out of the stock market because all of a sudden we're now at historical overvaluation levels only seen once in history. We're at levels exceeding, or at around the great financial crisis, 2008, the Great Recession, they called it, the crash of 29. That's the Shiller P ratio. I'm sure many of you have heard about that. If you haven't, let me know. I'll post a chart or give you a link to it. So we know that valuations are very hot right now. And maybe that's the new norm. We'll see. We'll see. But again, watch this. I've been covering this lately. The longer we tick up to here, this is what I've maintained now for the last, 2 years, especially since we put in this last year, since we put in a double top high there, that a break, that this is all the 30-year has to do. 10 years got a little more room to catch up to get to new highs. But when that level is taken out right here, that's a 5.1.5% yield on the 30-year. It's not just going to break out to multi-year highs. This is 2003 high right here. There's a 2025 high. But as I've covered many, many times, it's going to take interest rates back. That's the ceiling. That's the double top high we have. And it's going to take rates back to levels as you take this horizontal line across all the way back into the right before the dot-com bubble burst. And don't think that didn't have a hand in it right there. See those rising rates when things started to get hot? Rates were going up. It was March of 2000 when the NASDAQ 100, the NASDAQ peaked, followed by an 80% drop. And so from there, that seemed to be it's a very technically significant resistance level. We had a bull market then that went into the stock market, that is, went into the October of 2007 highs. That's right about where treasuries were then. And then came the bear market and the financial crisis. So interest rates drop and due to all the quantitative easing, everything else the Fed did. And they had the room and the power to do so. And then they just got cute. They figured, you know what? It's that easy. We'll never have a recession or a stock market crash or correction again. All we have to do is, if we do, like COVID, one off, we'll just print more and more money each time. And that worked great until it stopped working. Why did it stop working? Runaway inflation. And again, to me, guys, a more simple view, a secular shift. This has all the makings. Time will prove me wrong or correct. But, and again, years it's going to take. But my belief is that ultimately, whether we come down first, wouldn't surprise me, especially if the stock market triggers my, breaks the support below the trading ranges. You might see a big flight to safety on treasuries. You could even come in and backtest the primary downtrend line. But I do believe in the coming years that treasuries are going to take that out. And all I can tell you is that when that happens, again, I will eat my shoe if the stock market isn't melting down. If we have a solid and sustained break above those, again, not just multi-year, as I just showed you, but multi-decade high in yields, it will literally, to a pretty good extent, destroy the financial system as we know it, the banking system, which is highly leveraged, very complex. And I know, guys, I'm not here to preach doom and gloom. I'm not a zero hedge, all bear site. You guys know there's been more long trade ideas in the last year than there have short, but in the last few months, I'm giving you more and more shorts. I'm giving you what I see, opportunities, as I always will. And we're going to keep it spread out. So that's it, guys. That's kind of the bigger picture thing. Now let's just try it down to the charts. That's stock market, and then we'll move on. A couple other things I want to cover. Somebody asked me about Novo Nordisk. I'm going to cover that. I'm going to get to the VIX, the indexes here, financials, and then gold and silver. And that should be enough for this video. And then again, I'll try to run through an AI summary after it's all completed, and you can come in and if you want to check it later. There's nothing super time sensitive right now that I'm going to cover for you. I just want to say that, so you can watch this video at your leisure. Well, now if you're watching, you've already heard me say that. So, all right, SPY. Where are we at? Look at that. There's my midpoint range resistance 66.73.79. Provide an objective short entry. Covered that quite a bit lately. Unless you're brand new to the site, what it is, this is multi-month trading range over 6 months. And anytime I recognize a trading range, whether it's a price channel, let's say an ascending price channel or a declining price channel, just about any point, and I've noticed this years ago, around the midpoint, it could be a little higher, a little lower than the exact midpoint, there always seems to be a level that's very well defined as a kind of what I call a micro level within the primary channel, where it acts as support and resistance. So when you're above it, you're in the upper half of the channel at support. Once you break it, typically the next move is down to the bottom. If you break back above the top, then you're likely going to the top. So you can use that to buy pullbacks when you're in the upper part of the channel, or wait for breaks of support. And of course, the bigger, more important move is if we get a definitive, clear breakdown. Now I'm talking, why I say definitive, not an intraday pop that closes back above it, but a solid break, especially a solid close below. And it so happens that the 200-day moving averages will be lost for the first time since back here in March of 2025 if the channel breaks down. And the same thing in QQQ. The 200-day moving averages come just below, and QQQ is a little weaker right now. SPY is also, I checked the futures today. Here, I'll show you. The futures just rolled, so let me show you my new charts. I gave you in that that when I put up the crash warning, I'm sorry, watch. We're still on a watch, not a warning. Somebody asked me yesterday. That's much less. It's just less severe. A watch is just, hey, something to watch. Maybe it could happen quick. And again, I give you the exact levels, but I had to replicate this. This is ES. You can't see it. Futures have rolled. So I updated these levels, so they're going to be a little bit different. That's why I have a price alert set. This is the bottom of the trading range in ES, and there's the midpoint line. And I have another chart. Let me see if I did it. Did I do it on this one here? 60-minute. Did I go to? Yeah, there it is, guys. I like Fibonacci. I incorporate Fibonacci retracement levels into my trading. And so there's the peak, the all-time high in the S&P, and the quick drop down here to the bottom. And so that's the start. So the key Fibonacci retracement levels that I like to use are the 61.8 retracement, 50%, and 38.2, meaning 50% means you retrace half the level. And these are, if this is a counter trend bounce, if that was the high, and we are going to break to the downside of the range, which is right here, as I expect, then this is a typical stopping point anywhere in this range. From that 30, we kissed that 38.2 fib perfectly today. You can see that to the button. And I just wanted to point that out. That's where we retrace. So I say that because yesterday I saw a couple comments like, oh my, wow, what a rally. And the markets were up 1% yesterday, guys. Let's talk now about that. Let's talk about the VIX. And let me just get to IWM, then we'll get to the VIX. So IWM, small cap ETF. Also, with the two that have official short trades on are QQQ and IWM. But somebody asked me today, and I'm going to get to that comment in my reply in a second. But we've hit so far. You had a breakdown back test here, then you had a trading range. That was the trading range developed after we put the short on here. So we hit the first target, it bounced as expected, then took it out, went down. See, once the trading range was taken out, it was a swift move down to T2, just like what I expect to happen on QQQ if and when that trading range is broken. And then these are the next targets. I also gave you the targets on different for shorter term traders. You can see there was our entry right there. We hit the downtrend line, made a marginal new and still divergent high, and then we hit my first, second, third, and all four of my targets. And by no mere coincidence, T4 was hit and hit again, and that's support. That's what each target is. Upon the initial tag of each target, a reaction is likely. Just like you hit T2 here, you could have covered, game to bounce, and then reshorted at a higher level of resistance, ideally. So this is what needs to happen to smallies. They need to take out my second price target, which was hit here and hit again. And just like QQQ and SPY, if it does, you've got the 200s just below, and if they're lost, well, that'll be the first time since you can see it bounce, 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 bounce by the 200s, right? In a bull trend. When you're below, you're in a bear trend. That lost them right there. If you shorted the break of the 200s, then, well, you made about 21%. And then right here, it came up. They checked the 200 exponential, got rejected pretty hard, took it out, but then got rejected off the simple. So now you guys see why I use both, because some traders look at one, the other half of the traders look at the other. Therefore, I watch both. And I like it when they're pinching together, because then they're more likely to both be taken out. And that's it. The exponential just moves faster due to the calculation they use. That's all. But again, it's really simple stuff, guys. I mean, it's not, and nothing's guaranteed. Don't get me wrong. You don't have to go mortgage your house and put everything in short, because IWM breaks the 200s. Take this stuff collectively. Look at what's going on in the credit markets and the financials and the S&P 500 and the NASDAQ 100. Because why? Because if IWM breaks down below the 200s in my T2 level, but at this very same time, QQQ and SPY hit and hold the bottom of their trading ranges and or go break out to the upside, the smallies are only going to go so far down, right? That everything, stock market, a lot of these things are just correlated and indexed together. Even though there are different indexes, obviously there's all the stocks in the Russell 2000. None of those are in the S&P 500 or NASDAQ 100. Those are large and small caps, but equities tend to move together. Okay, now let's talk Mr. VIX. Okay, started noticing this uptrend line, and I was highlighting every pullback to it as an objective short entry, both at the time and in advance. And that after that one, last time I highlighted, said I don't think we're going to get another pullback to it. No, look, we still could. VIX could collapse. Maybe the markets are going to go to break the up, and they will. If the market breaks out, S&P and QQQ break to the to new highs above those recent trading ranges, yeah, the VIX is coming back down. I'll tell you that right now. But what I can tell you, VIX is at support right here. These are targets that I gave you before. I'm highlighting the VIX since its most recent divergent low, just like that divergent low and the one before it. So far, we made it very close, but not all the way to that 3750 target. But I believe if and when the bottom of the trading ranges are broken, and we go down, and assuming we hit my next deeper targets on the weekly charts on SPY and QQQ, we're going to go up probably up to that 60-ish level on the VIX. And what I can tell you definitively, I'm just telling you if, right? Again, no breakdown, no sell signal, no breakout to new highs, no, those are all things to watch for and then react to accordingly. But I can tell you that right now, just like I showed you, the S&P 500 ran into key Fibonacci resistance plus the midpoint of its trading range today, that this is an objective long entry, with the VIX also pulling back to price support. This isn't a random line. I created that line back on August 3rd. Well, I last updated it. See, if I move it, I don't know if I change a color, if I do anything to it, then it tells you the updated. But I last updated it on August 19th of 2025. That means I haven't dragged, touched, modified that trend line. So that was, back here, it was a target that I gave you, resistance. We hit it right there. And then we went on to hit that next target. That's a target I've had there for a while off that last trade. We were along the VIX there. And we hit that level again. We hit it again. We took it out there. We punched up. I thought there was a good chance that would be the catalyst to break, with the markets going on to break down. Now, I still think they will. Nothing's changed my outlook. I can just tell you this is support. And look, if I'm wrong and we do get another back test of the trend line, that will still be an objective add-on or new entry or add-on or new short entry or re-entry on the VIX. But if it breaks below that, and again, also watch the stock market. I never, ever, ever, ever trade the VIX in a vacuum, the same way I never trade GDX in a vacuum. I only trade GDX by looking at gold, silver, and the dollar. And if I can't make a bearish or bullish case on gold or silver, or a bearish and bullish case on the dollar as well, then I don't touch GDX, right? I need that aligned. So there's the VIX objective entry. But I'm going to reiterate again, if you're new to the site, I'm spewing out this, bearish talk where I think things are going. But most importantly, if you're brand new to the site, this will be the first time you heard it. If you followed me for a while, it's probably the 10,000th time. Support is support until unless broken, right? That's it. We need to take out 589 and the 200s on QQQ. We need to take out about 652 or so, 653, and the 200 days on SPY to get the party started. And the party, as I expect, will be swift and pretty swift and furious. These are my longer-term targets on the S&P 500. Maximum downside from the recent highs, if hit. And I'm assuming right now I'm going off the working theory that was a major top. We'll see. Time will prove me right or wrong. I thought that was it back then. Thought I had a good chance, but guess what? We went down. I gave you a total of these same exact targets, and we hit the third one. And if you go back to the site on was the April? Why is it showing March? That was 2025. Yeah. Oh yeah, March. Okay, that was a big. Yeah, that was the April candlestick. That's the April lows. Posted a hard cover, all shorts, go full hard long. Because again, everybody else thought the world was collapsing because of Trump's tariffs, but we were already short off the highs, and that's where I stated that's enough. He will cow down. The Illuminati will walk him into the back little hidden room under the Oval Office and tell him back off. And so long before taco was a thing, Trump always chickens out. I made that prediction that his ridiculous. Remember how, what was he talking, 300%? I said, that'll never happen. The world economy is too intertwined, and he would just crash everything. And so, again, that was my point I'm trying to make, guys. Again, I'm jumping around, being tangential. That was a significant high. We were, I fully expected cover to bounce there. I did not expect it to go as high as it did, but from the bigger picture, it's really, not that much more. And you look at SPX, the S&P 500, you can see I have different boards. Let me show you. Let me find which. Well, I'll just take that. You've got a couple trend lines. You can see a primary and a secondary. I haven't marked the S&P SPX up a long time. Let me see if I have a board for you, maybe on the monthly. Yeah, there it is. Okay, so this right now, this is the main trend line that has to go. That was that previous divergent high, and all we've done is made a new divergent high. And while I'm on the monthly, let me just talk about this real quick. Here, we'll go over to SPY. Okay, I'm going to show you two charts right now that I think are very important. And again, it's bigger picture stuff. And I say this, again, there weren't a lot, but a couple comments. And guys, I love you guys. I appreciate you being subscribers here, and I value all opinions. But in a couple comments, there's wow, what a rally. Again, the markets were up, both the S&P and NASDAQ 100. They were up a little higher intraday and then closed 1%, which is nothing compared. If you look at measures like the ATR, put that up on your charts, called average true range, shows you what the price swings are on a security. That's high. The VIX is high. So again, what I want you to, and I said yesterday, don't read into a move unless, and it wasn't even a big move in the market. It was a relatively, again, relative to the recent volatility, a relatively small move yesterday, 1% move. Did nothing technically significant. Didn't take out. It was below that 38%, 38.2 retracement on the S&P futures, like I showed you. It was below the midpoint of the range. It was nothing but noise. It was nothing but just an up day after a series of of mostly down days. Now, this chart I covered recently, but again, I do all this stuff, and for those just catching up, whether you're an existing subscriber or a new member of the site. This speaks pretty clearly to me. These are the, I call them hills. This is the PPO histogram. That just shows you these green and red bars show you the differential of the lines on the PPO. Let me move my chart over here and grab it. PPO, where's my PPO? I can't even. Okay, I've got it somewhere here. One second. Oh, I see why it's not on the side. I have them squished down here. There it is. So PPO is my preferred indicator. Years ago I used the MACD, and then I found I like the PPO better. Very close cousin. If you don't have a PPO, you can use MACD instead. And so basically, what it shows you, you can see my divergence lines, is when the two lines make a bullish or bearish crossover. In other words, this is your signal line, and this is your PPO line. Signal line's a 9 EMA of the PPO line. And again, it's a pretty damn good track record. So you look at these hills and they tell you you're in a bull trend, be long and strong, especially your 401k, but even as a swing trader. And so what happens is, and I've covered this quite a bit, including recently, when you start going down, you're losing momentum. The market's still going up, but momentum is stalling. And it doesn't take an expert. You can clearly see these are monthly bars. Momentum's going down, and ultimately the correction's fallen. So that's what you're seeing here with these purple lines. Again, these are just the last few. The red hills are when you got the crossover. And you can see, as I've showed this to you recently, the top comes, and you're still bullish. This was what this was. It was clearly the momentum was waning, but then we had a last minute hurrah, kind of like that, what I call, I talked about the market having terminal lucidity recently. That's the medical term for when you have a terminal patient, if you've ever had, and I'm sorry if this hits hard, a family member, a loved one, or if you heard the story where somebody is dying. They're on hospice. That's the ends. There's no chance of recovery. But then they have that sudden moment of lucidity that not everybody, but you hear these stories where they, just everything's great. You think they're getting better. You have great conversation, and then boom, they quickly go downhill. And doctors are aware of this. They warn people that don't be fooled by that. The prognosis hasn't changed, but it's just a known phenomenon. You can look it up. And I said the market has, and sometimes you get it here. And you got it. You could see that momentum was waning. You got one little blip, one little bar after that cross. That was a whipsaw, but then came the 20% drop. Here, you could see your next crossover right there, 36% drop. Then you had a bull trend, right? And then the top came right here. There was a 27% drop, all marked by that, the red histogram bars. You could see we started to go down. The market peaked right there. Then the cross came the following month. Once the cross comes, the top's usually in, right? And again, the bear, I'm looking, that was the first red. You might not see it. I can see it there. You can, or I can just show you. I'll put a little crosshair if you want, and show you the histogram was PPO histogram was right at the. It's a slight red bar. You can see it there. I'm almost flat. 21% drop from high to low, and here it is. We've crossed now. As I often say, this is a monthly chart. All that matters is how it closes over the month. This red bar right here, which is pretty solidly red right now, can vary. Well, it's going to be hard. You'd have to have a hell of a rally. You'd have to go and break out of highs. Why? Because once these bars start rolling over, you have to understand that when you've been going up, you don't have to just go down to get make the PPO histogram go down. Just simply going sideways means the momentum has now reversed or stalled out. And that's, again, what this is reflected. So you're always going to see the stock market going up as the PPO histogram drops. And this is, guys, a big part of my trading. This is why I tend to be in front of trades, not behind it. And one reason I call it right side of the chart. I try to anticipate these tops and bottoms, which to this day I hear these people come on, Bloomberg and CNBC saying it's impossible, and I don't get them all. Sometimes I'm positioned for a bottom that doesn't come or comes later, and sometimes I'm positioned for a top that doesn't come or comes later. But on that, I always say there's the big difference between being early and wrong. Early is if you position for a trade and then you're stopped out for a loss because the move was exceeded your stop parameter. That's being, I'm sorry, that's early. That's wrong. Being stopped out. And being early just means, like right now, the market has stalled out, and we've had sell signals. We've been short. We've even hit targets. So right now, technically, we're not wrong. QQQ set our first target. I just showed you on IWM on the daily chart, T2, but T4 on the 60-minute chart. So again, right or wrong depends whether you're covered there or not. But the longer term targets, time will tell. And again, this is a pretty damn reliable indicator. And so, like I said, we can reverse, but it would take a pretty big move with today being March 17th to flip this indicator back to close the month green right here. Possible, but not probable, in my opinion. Okay. And then QQQ, you can see the same thing here. Guys, again, the purple lines mark the peak, the candle that the highest point before the drop, 24% drop, triggered, followed by the bearish PPO crossover, 31% drop. There was your bearish PPO crossover. That was COVID. If you blinked, you missed it, but it was there. Very profitable to short and very profitable to close your longs and sidestep. 38% drop there, peak of the market. Market held up for another month or two, and then starting that third month, there's the crossover. And then again, so I'm just showing you the purple lines. That one, you had one, there was the top. But again, guys, a blind man could see it coming on all these using this histogram. And look where it is now. So we're clearly crossed. And now, so if this changes, and on April 1st, we have a big green bar because the market's broken out to new highs. I can't tell you what I'll be saying. I can't tell you right then if I'll abandon my longer term bearish targets, or I can just tell you that's going to be a bullish technical event. It may not be the bend. And then look, and if we do it, but look, let's say we do it and we have a slightly green bar. Most likely I'll just be pushing off and just expecting those targets may take longer to play out. Because I do predict any new high anytime soon will be a marginal new high. So I'm just going to tell you that right now. It's, again, you start getting now green bars that start building from here. Yeah, then something different's going on, right? Something, maybe the Fed just floods the system with liquidity and prints away. Who knows? So we'll just have to stay flexible. All right. But I just want to point that out because these are very, very, very they have a very accurate track record of predicting every single one of the biggest drops in recent years, bear markets and corrections. And then last but not least is crude oil. This is the chart I shared with you back before we got here a couple weeks ago. And what I showed you down here, let me make this change the color tool. This was the financial crisis. This is the S&P 500, SPX, down here on the bottom, right here. And this is crude oil, WTIC, West Texas Intermediate Crude, aka light crude oil, right? And I've, noticed over the years, 78 seems to be about a magic number that when approached from below, bad things happen to the stock market. Just like the stock market and the economy love low interest rates, right? I think I pressed that point in the beginning of the video. What else does the stock market and the economy love? They like cheap oil, right? What do they loathe? Expensive oil. So, when crude's low, it's just don't even pay it much attention. But 78 seems to be the magic number, and it's what these dotted lines show you. When hit, there was a correction there. Didn't crash. We went up again. We pulled back. We hit the 78 level. We never crossed it, by the way. Crossing that threshold is the problem. So we hit it there, and then we finally crossed it, and then came the financial crisis. You may say, yeah, Randy, because that was the housing market, or that was the CDOs, or that was this, that, or the other. It's all related, guys. It all comes in together. Trust me. If we had cheap crude oil back then, The GFC may have been delayed, postponed. There was a bubble there, but that certainly exacerbated it, and oil kept going up long after that. So that's it. So and the more it went up, further pressure put on the economy. Then we had oil crash because the economy crashed, and that's called demand destruction right there, right? Um, Not as many planes, trains, and automobiles moving around during the recession, so not as much crude oil being used. Then we approached it right here, got above it, and we had the biggest correction since the bull market started right there at the end of 2009, right? And we went up again, had another correction in the market, but at this point, we had already crossed that threshold. We had the correction. This was, again, the biggest injection of fiscal and monetary stimulus up until COVID. Again, it was unprecedented at the time, so it just juiced, and the market was even able to shrug off high crude prices for a while. Then crude got cheap again. Then the first time it hit it back here in 2018, fourth quarter of 2018, kissed that number. That was a big drop. That was actually a over 20% in the small caps and the Nasdaq, close to a 20% drop in the S&P. That was COVID right there, but crude was already low, and then demand destruction. Hit it, and it popped above it there, and that was by far the biggest bear market since the global financial, the great financial crisis, right? And then dropped below it right here, fell back below, but kissed that level again, correction. Okay, went through there a few times, kissed it right there, bigger correction. And then what did we do recently? We didn't just hit it, we blew through it. Recently, crude hit, I think futures were over 120, might have hit 130. And we're still well above it. I'm looking on, this is an end of day chart. EOD, when you look at this, means they update it every day, but I'm looking at another monitor. Crude's at, futures are at 95.21 right now. So we're in nosebleed territory, guys. And I've talked about that quite a bit. I just wanted to say that this chart, together with the other one, again, nothing is written in stone, but that's a lot of evidence, in my opinion. A lot of evidence that tells me that we're probably going to break to the downside of those trading ranges and hit those additional targets soon. Okay, I didn't realize how long I've been talking. I don't want this one to run an hour, so I'm going to stop it soon. Anything else? I'll cover financials. There's nothing much to report new today. I updated them yesterday. This is the dollar index. This one I'm watching really closely. Big bullish, aka positive divergence. You had a bullish, just like that was a divergent high, negative divergence right there. Caused a drop in the dollar, which is it's basically like for you gearheads, it's like putting avgas in your, the muscle car. Avgas is aviation fuel. Some people trick their engine out. It'll burn your engine up if you keep running it, but it's super high. Planes run on different octane, higher octane fuel than, and so that, or you call it whatever, pouring gas on a fire. That was the juice in large part for the big rally in gold and silver and going parabolic. Gold and silver moved inversely to the dollar. So the dollar bottom there, it broke out of the wedge, but it's been hitting this really nice support. I just covered this the other day. It's about 100 on this, and that's positive divergence. So if the dollar, and again, from the look of this chart, I think there's a good chance we break out there. That will be net bearish for gold. Net bearish doesn't mean gold must go down. It just means you cannot argue a rising dollar is a net bearish factor for gold. That's just a known fact due to the way gold's priced. I'm going to pull this trend line down a little because I had an alert go off on it today. That was the first target I had after this trend line break there. Or no, it was this one here. We shorted, that was the crash in gold and silver back there after that divergent high. I'm sorry, T1 was this horizontal line here. And that was hit. Let me do that. Either way, this is the trend line to watch right now. Gold, I still have these additional targets for you. I know the whole world now. I can't find a single gold or silver bear out there. But as you guys know, we called the crash in silver the night before it happened. Warned of an imminent crash either the following day or the following week. That was on a Thursday night. It crashed on that Friday. and biggest drop 30 years. And then I showed you on the long-term chart, which I don't have time to get to in this video. If you're new to the site, I'll reference that coverage and chart for you if you ask me in the comment section. But I said after silver goes parabolic, which you're not seeing on this 60-minute chart. This is just my hourly chart. That it drops about 30%, give or take, which it did. It was 40. Again, give or take. The bigger the bubbles, which this one was, the bigger the crash. And then it goes sideways for a while. Dip buyers are like Pavlov's dogs. They can't help themselves. All those that didn't want to buy silver here and here were just foaming at the mouth to get in there. So they're going to buy. And so you get this, again, history shows. I've showed it multi-weeks, usually a couple months of sideways consolidation, followed by the next leg down. And parabolic trendline break is typical of a top, not a correction. And so again, you can call it what you want, semantics if you want to call a 40% drop. I call it a correction so far. But anyway, here's the magic number, guys. So I showed you what the dollar needs to do. If it does, it'll help support the case. This is the big level on silver right here. You have an uptrend line. Price level, I don't know, I have two lines there at about 66 to 65. And then this uptrend line right here. Once that breaks, that should bring in the next these lower targets on SLV. And again, I've covered the miners just with you recently, and we also have longer term targets on the miners. Miners recently broke and back tested this trend line here. Needs to break 92.24, and we'll go down. Your first target's this trend line and or intersecting, price support there, T2, T3. All right, so that's the update on the miners metal. So this is what I like at this point in time. And again, additional sell signals to come, which would give me the green light to increase, get a more aggressive position size, but that's short GDX. Primarily, again, I have no desire to think gold's going to outperform silver. Outperform, by the way, also doesn't mean that gold will go up if silver drops. It just means it's going to drop less. So, I think silver's poised to fall more, and the mining stocks by far. This crude oil surge has not been priced into that. I've spoke to that recently, that's a net bearish impact other than the rising dollar and rising very high fuel costs. Again, if fuel's down below 78, 80 a barrel, it's not a big deal. It's kind of what everything's used to. You get $100 plus crude, it's gonna permeate all into the economy. It's gonna hurt the miners' profit margins, and of course, most importantly, if gold and silver fall, the miners fall. So those are your levels to watch, guys. I will stop it here, get the video out, and as soon as it's up and running, I'll post in the comments section. I'll try to post that AI generated summary so you can skip ahead to whatever you want to listen to. This has been Randy Finney with Right Side of the Chart. Have a great day.